Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, September 26th, 5:47 p.m. Eastern Time, coming to you from rainy St. Augustine Beach, Florida, with tonight's Revere Market Insight video, where the weather matches the results of the market on the day. State of the market. We are in a mild correction, between 7 and 8% off of the highs from late July. You can see over here on the trend gauge, more red than green arrows is certainly not a good thing. We downgraded leadership late last week when they finally came undone. Short term, all five of the major indexes are below their downtrending 21-day moving average. Medium term, same thing, all below their downtrending 50-day moving average. Things got a little bit worse today, long term, as the Dow broke below the 200-day moving average to go along with small caps and mid caps, which have been there for a while. S&P 500, a little less than 2% away from the 200-day moving average. NASDAQ 100 still substantially higher. So what happened today? Gap down, all day trend down. Dow broke below the 200-day moving average. Not a whole lot of good to say. We've seen the deterioration take place and really accelerate after the Fed. The unwelcome hawkish view of Jerome Powell and the FOMC last week has continued to cause the market to accelerate to the downside. We're getting extremely oversold. We're going to take a look at some ATR charts. Just because you touch a -3 ATR doesn't mean that you're automatically going to get a bounce. We'll take a look at some of that. But we are extremely oversold, but that's not a reason by itself to turn around and start buying a bunch of things. It is a reason not to be adding shorts when you're this far down, but that's a whole different discussion, not for this video. So here are the final numbers. The RG8, our 8 growth ETF composite, down 1.24%. S&P 500 gap down 0.6, and had a trend down all day, closing near the lows. Minor bounce at the close on some rumors that there may be an agreement to not shut down the government on October 1st. We'll see if that plays out. That could be the catalyst for a bounce. But for right now, nothing doing. S&P 500 down 1.5%, along with the NASDAQ 100. Dow down 1.14%, mid caps down 1.55%, Russell 2000 small caps down 1.27%, Global 60/40 stock bond down 0.91%. Minimal contribution from bonds today, just barely down as they are consolidating at extremes. In-house GROTECTION with our 0.6 beta, we should be expected to be 0.6 of whatever the S&P does. That's about right where we are, down 0.9% on the day. Break of the sustained break of the 150-day moving average, which is basically where we are right now, and then the 200-day moving average below that. We know that's where the extremes occur, and all bear markets occur under the 200-day. I'm going to show that chart a little bit later. It's making a revisit. Was a mainstay of these videos during the bear market, but we're breaking it back out again. You'll see it when we get to the tail of the tape. Let's get right into it. And we'll start off with the S&P 500. The pink line here is the 150-day moving average. If you go to the weekly, the pink line is the 30-week. The 30-week slightly higher than the 150 days. So you can see we've got a close 0.3% below the 30-week, 0.2% above the 150 days. So there's a range of support right there. And note that we're right back to this January 2nd breakout level where I've got this notation. We were consolidating sideways to up, and then finally broke above on 6.2. That let off a nice run. But this is why we say it's not how much you make in the markets, it's how much of that you can keep, as the markets have given all of that back now. The catalyst with the arrow here, the FOMC last week, very stretched to the downside. As I said, we'll take a look at the ATR charts in a minute. NASDAQ 100, same overall setup. Where's June 2nd here? We actually broke out soon, but well before on 517, as this is when the big Nasdaq stocks were uh, taking the lead in a major way. See where we are on 6-2 right here. Same situation. We've given that all back since 6-2. And you can see from the relative strength line that NASDAQ 100 stocks have basically done what the S&P 500 has done. It's slightly jagged, but the beginning point and the ending point are about the same, meaning it's just in line with what's been going on with the S&P. The big outperformance was here for the month of May, starting mid-April, and then in January. Then we consolidated in February. This is a perfect consolidation. I featured this picture last week. You can see the RS line going sideways. These are higher beta stocks when the relative strength line is just going sideways. When they're consolidating, they're not giving back any ground, and that um, set the tone for the leadership that it expressed from mid-April to the beginning of June. Then continuing to go higher, but just basically in line with the S&P after that. So there's your NASDAQ 100. Did finally break below that the 818 lows, so making lower lows. And speaking of lower lows, here's the Dow Jones Industrial Average breaking below the 200-day moving average today. Let's go back to June 2nd right here, given all that back up and relatively just about in line with the S&P 500, but not in a straight line. Big underperformance there. Big outperformance there, underperformance, outperformance. And this this basically goes in line with when the market is going up, you get relative weakness because this is a defensive index. When the market's pulling back, you get relative strength, meaning it loses less, but also makes less. The beta on the Dow is about 0.8 versus the S&P 500. And here you can see the break below the 150 and 200 day, which are pretty stacked pretty closely there. Let's go to the problem children, the mid cap and small cap indexes. You can see you've got the 50-day breaking back below the flat 200-day moving average on mid caps here, 5 sessions below the 200-day moving average for mid caps. Your small caps, 150-day has broken below the 200-day moving average, which is now slightly pointed down. And again, you can see 7 closes below the 200-day moving average, getting really stretched to the downside. Those are the major indexes. What did the VIX do today? Not beneficial. That 18 level in the 200-day moving average that had been providing resistance gave way today, and we broke above that, up 12% on the day, up near 19 now is the VIX. And certainly as the VIX goes up, that rule of 16, we're back above 1% on the ATR of the S&P 500 after breaking back below it a couple of weeks ago. Let's go to the dollar. Dollar extremely strong, making higher highs, up 0.3%, offering no assistance to the general market. And if dollar's strong, I think you know what gold stocks and silver are going to do. Here's gold down 0.8%. Here are gold stocks. They got really taken to the woodshed today, down 2.7%. And silver down 1.13%. Bitcoin basically flat, consolidate in a consolidation. Let's flip to bonds now. Not a lot of range in bonds today, but making lower lows. Here's BND, the broad bond index, down 0.1%. Here's TLT, 30-year making lower low, down 0.35%. Here's the 30-year yield, TYX, up 0.82, making a higher high, and TNX, the 10-year, up 0.35, making a higher high. That's our inter-asset correlation. Let's get to the tail of the tape. You can pause this as I bring it into the screen. The stochastics, all extremely stretched, but as we've said, you can stay stretched for a while. Day count, the O'Neill rally attempt day one is over. We're down 4 out of the last 5 days, 8 consecutive closes below the 80 EMA and the 21 EMA on the S&P 500. Our expectations continue to be negative. We put the high end right at the open 15-minute range, even though we gapped down 0.6%, a little bit of a bounce toward the close, but 11 out of 11 spider sectors lower. The worst being XLU utilities, which had been showing some relative strength, but dropped 3% today. Biotech, the only significant up sector on the day. SSO continues to be our only holding, along with NVIDIA and some taxable accounts. NVIDIA holding up pretty well, holding around that 420 area. So no changes to the portfolio today. This just dropped down a tick because of the loss that we had in the portfolio today. So basically, the long becomes a slightly less percentage of the portfolio relative to the cash and the T-bills. Bottom line on the day, gap down. All day lower low, lower high. That's a trend down. Dow breaking the 200-day, S&P at the 150-day 30-week level. Could be a spot for a bounce, but we've said that for a while, and the market does not want to give any bounce. You can see we broke below this key multi-layer burrito of support today without putting up much of a fight. First order for the bulls would be to regain this, but you know what happens once support turns into resistance, and this did act as support on the prior pullback. You know, every time it's tested, it gets a little bit weaker and finally gave way today. And basically, we're right here at this 150-day slash 30-week moving average. Let's take a look now at some of these ATR charts. And this is the S&P 500. We noticed a couple times and we mentioned logical spot for a bounce, which we got yesterday. That happened to be the third day where we touched or came close to touching the -3 ATR. The problem is that bounce is not guaranteed. Here's your first touch. But when the slope of the line is going lower, you can continue to make lower lows and still stay within that -3 as the 21-day moving average is rolling over. The ATR lines are going to roll over also. So we actually closed that 42, actually 42.65-ish was the low that poked its head below the 3 ATR, and we closed just basically right on the 3 ATR. Let's go back a little while, and you can see in a very similar manner when you get extended to the upside, which we were back at the beginning to the middle of July. We climbed uh, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days in a row. This is when we had the red stop sign warning out about stop adding positions because we're extremely extended. And then, of course, you know how that resolved. The big gap up and then the failure on 7/27. This was NVIDIA earnings, consolidated inside and then broke down on August 2nd. This was really the beginning of the pullback. One bounce back up that got near +2 ATR, but now in a extreme pullback mode right here. Let's also take a look now at TBT. This is 2 times the long bond, the inverse of TLT. So basically, if rates are up, this is up. We took our profits at the +3 range here late last week. You can see this because it's a 2 times, it can get extremely extended. You can see we touched the +4 ATR back here on August 3rd before pulling back. One close above the +3 here before pulling back. 2 closes above the +3 and approaching the +4 these last 2 days. We know how these extremes always resolve with a harsh break back toward the mean, but we don't know when exactly that's going to happen. But we're on the lookout for it, and that's one of the reasons why, as extended as we are to the downside, we don't just automatically dump our index long position in the S&P 500. We know when we're down this level, bounces happen all the time. We also know we don't get into significant trouble, and here it is, unless we break below the 200-day moving average. These are all of the bear markets that have occurred uh, going back to 1968 to 1970. You can see the severe ones. You can see the October. You can see the 50.5% drawdown when the internet bubble burst. You can see the 58% drawdown during the financial crisis. The 35% drawdown with COVID in 5 weeks. This is what I feel these two here are kind of the circumstances that we're in. September to December in 2018, this is when Powell, the market, the chatter was that he was on the wrong side of the interest rates based on what was going on with the economy. This was the bear market of 2022, down 27.5%. But this reminds me of this level right here, and we're only 8% off of the highs that we made at 4607 back in late July. So if it gets to be a true bear market, it'll happen when we break in 2%, when we break below the 200-day moving average, and then we just get the heck out of the way and let the market figure out what it wants to do. What we're trying to do is avoid these big losses, and the plan, and again, they all occur below the 200-day moving average. So that's when we get out of the way. It's very easy to recover from an 8, 9, 10% uh, drawdown. It's these severe ones that are a lot more difficult and take more time to come back from. And if you're approaching retirement, you just don't have that time. One other one I want to take a look at, and this is XLRE. We got an email uh, talking about how DRV would have been a great play with this, and I agree 100% it would have. Uh, we were playing that not with DRV, but with TBT, which got extended to the upside. I can bring up DRV. This is a 3-time inverse real estate, and that looks a lot like TBT, which we sold late last week. You can see that's extended at the +4 ATR today, just the inverse of XLRE being extended to the -4 ATR to the downside here. And again, these big extremes always resolved. You can only stretch the rubber band so long, but it can continue to go on for a while. We're not going to try to pick the bottom, but the market needs some sort of a catalyst, whether it's PCE inflation data later this week, something that Powell would say, whether it would be a solution on this uh, government spending issue that we're talking about. Uh, we don't know. We know that when it'll start, and then we start counting 4 days off the bottom, looking through our follow through day. At the same time, we're tracking leading stocks to decide what's holding up the best, what has good fundamentals that could possibly be a market leader if the market goes from this pullback back into a bull market. And we are coming up on the most seasonally attractive time of the year, usually starts mid-October and then through November, December. But we don't make any predictions. We don't automatically get long because of that. There have been plenty of fourth quarters that have been terrible. I just pointed out one back in 2018. We certainly don't hope that that happens, but we're prepared to weather it if it does, and then be ready to catch the turn when the market bottoms. And that's why we say it's not how much you make in the markets, it's how much of that you can keep. These are our expectations, the way we manage portfolios, depending on what the market conditions are now. Right now, we're in this mild correction between 4 and 8% off the recent high. We should be expecting in line. We pull back in line with the market, and that's basically what we've seen. If the pullback gets more moderate or harsh, at this point we've broken below the 200-day moving average or are very close to it. 8% normally you're right at it because you start. Usually you start. In this case, we were 12% above the 200-day moving average when the pullback started on 727. The slope of the line has increased up so that it'll be between 8 and 9% if off the highs, if we finally do break the 200-day moving average. But it's the harsh correction, the bear market, and certainly the severe bear market that we want to avoid. And we'll be in the safety of cash and or playing some index shorts. And that's how we get crisis alpha or crisis outperformance relative to what the indexes are doing, just the same way we get outperformance during a bull market or a strong bull market. That's our expectations. That's the way we run portfolios. If you have any questions, I'd be glad to answer them. Reach out to me, don@revereasset.com. If you're interested in becoming a client, you've been keeping Danny busy lately, we'd like that. Dan@revereasset.com, or the phone is 855-REAL-WEALTH. That's 855-732-5932. And with that, and a reminder again that it's not how much you make in the markets, it's how much of that you can keep. This is Don Vandenbord wrapping up the video for Tuesday, September 26th. Don Vandenbord with Revere Asset, telling it like it is. The news you need to know, not necessarily what you want to be told, but it's what you need to know. Thanks for listening and have a great day.